Okay, so welcome everyone to week 6. This week we're going to look at customer attrition, and this is also improvements to engagement and retention. This week we've got a guest speaker, Sir Daniel Plowright, on the call, and he'll run through some slides and give some of his expertise. Just a quick summary of the 12 weeks again. So weeks 1 and 2, we looked at the key business growth drivers and how by focusing on making small incremental gains, the impact compounds to deliver outstanding growth. Weeks 3 to 9, we go into much more detail and give much more practical, real world, low and no cost things you can do to improve business growth drivers, covering quick win cash, your instantly available savings and opportunities with overheads, cash flow, the fastest way to improve your bank balance if the cash is tight, and reduce your stress levels. We then explored strategies to improve gross margins, and before that we looked to plug the leaky bucket by improving customer retention, working to upsell and cross-sell to better serve customers' needs and sell more to existing customers. And we'll continue that theme into week 8 by looking at strategies to increase the number of transactions and the transaction value. And everything before last, but by no means least, we explore new customer acquisition. You will be stunned to discover just how much growth potential exists, and in most cases before working to acquire new customers. So now we need to know how to grow the business, but to what end? We need to know exactly by how much and by when. We need to grow the number to give us the lifestyle we desire. Armed with a target in terms of exit valuation and timescale, we need to know what goes into preparing for exit, and it's a lot more than people appreciate. Finally, we now have the core structure in place. We need a detailed plan, a detailed 3-way forecast covering profit and loss, cash flow and the balance sheet in order to track and record your progress as we move forward. So whatever your goals, you need to be clear on what you're trying to achieve and by when, because a goal without a timescale is simply a wish. We need to be mindful that survival is not success and the odds are stacked against us. For those who do not have a very robust plan, the chances of success are all but zero. If your business is destined to be part of your estate and your funding plans for the future, gambling on a 1 in 2,222 is not smart. Achieving your personal and business goals requires planning and process. We also highlighted the fact that we must focus on the lead indicators, the drivers of success, because if we only focus on the lag indicators, so the sales, profit, cash in the bank, effective management control is impossible. You can only control the lead indicators that drive success, and to do that, you need to know what they are, measure them, take action to move and improve the key drivers, and set targets and monitor progress over time. Remember, Sir David Brailsford took over the British cycling team in 2002. We'd only won the 1 gold in 67 years. In 2008, at the Beijing Olympics, we won 7 out of 10 and repeated that success in London 4 years later. The team then went on to win 3 out of the 4 last Tour de France. How did they achieve this? By breaking down everything that goes into cycling and finding ways to make small 1% marginal gains to achieve an overall increase in performance. What worked for the British cycling team will work for you. These webinars are here to educate you on small, easy, but highly effective ways to increase your business performance by finding and implementing ways to make small 1% marginal gains, and success will look after itself. So in business, whilst your business will have more, these 7 business growth drivers are by and large universal. So margins, overheads, new customer acquisition, customer retention, transaction value, purchase frequency, and the odd one out on the screen, because it's not a business growth driver, is cash flow. It is critical because if you run out of cash, there is no business. We've already introduced Alex and KPI and the planned dividend payment with 80k profit, up 33% on last year. Alex and the family are looking forward to paying themselves that 40k dividend this year. They're excited at the prospect of holiday in the sun, moving to a larger house, or a whole new wardrobe of clothes to wear. However, there's a problem, and it's down to cash flow. Despite the increase in profit in the bank, the bank is overdrawn by £53,000. So Alex has to explain to the family, there's no holiday, there's no house move, and existing clothes will have to last a little bit longer. But never mind, because next year will be better. But will it? We also looked at these 3 scenarios. So number 1, we worked to increase sales. We looked to impact Looked at the impact of 50% more sales, which was 50% more stress, workload, and everything that goes with it. And we saw that rather than it reducing the overdraft, things just got worse. We then looked at the impact on credit control. At the same time, to improve debtor days. As you can see, this had a massive impact on the overdraft, moving from 53k of debt to a positive 54. That's a positive movement of £107,000. Finally, we looked at just one more scenario, the easiest of the lot. We looked at what would happen if Alex had simply focused on debtors by outsourcing everything to his accountant. What would happen to Alex's bank balance? This moved into a positive movement of £87,000. As you can see, busting a gut to increase the sales by 50% versus reducing debtor days, the difference in the bank balance could be as little as £20,000. Getting someone else to take care of the credit control and bookkeeping is easy, and it will almost certainly pay for itself. It will leave you with more time and less stress levels, so you can focus on what matters, growing your business, whilst they manage your cash flow for you. So whilst your business might have more, the 7 business growth drivers that apply in some way, shape or form to every business are those there on the screen. We saw in week 2 how tiny improvements in some or all the business growth drivers compounds and quickly delivers fantastic results. Once you have your 5-year goals and you've mapped your future at a high level, it makes sense to break down the targets. So where I want to be in 5 years can be articulated as where do I want to be this time next year? Then the year can be broken down into quarters and months, or into quarters and weeks as part of a regular 90-day planning cycle. This is where we are at the moment. We've now covered 5 out of the 12 sessions. We've looked at the massive impact below the line adjustments can have on profit and the cash in your bank without looking at customers. So having optimized overheads, cash flow, and work to maximize gross margins, let's move on to start looking at customers. You'll see that we are not going to look at new customer acquisition for another 3 weeks. We're going to start by looking for the low-hanging fruit that is customer attrition, or maybe more accurately, improving customer retention. New customer acquisition is invariably a very high priority issue. It gets lots of resource, lots of management focus and discussion time, and acquisition is normally a key metric for business. How many of the new customers do you need to require to simply replace the customers you're losing? The average annual customer churn for UK businesses is between 15 and 20%. This is massive. It means the average business has to replace their entire customer base every 5 to 7 years. For some businesses, churn or client attrition or lost customers is much higher. So this is a huge issue and one that deserves a much higher profile in management discussion and activity, because it's so much easier to retain an existing customer than to find a new one. Just think, you have to find and then invest time and effort to develop a relationship with a new prospective customer and eventually coax someone who does not yet know, like or trust you to cross the line and make that all important first purchase. The key message here is, if you think of your business and your customers as a bucket, new customers come in at the top, while lost customers disappear out the holes in the bucket. Before you fill your client bucket, you really do need to focus on understanding what is causing the leaks and work to address and reduce the impact of customer attrition to improve customer retention. So do you know how your business is performing in this critical area? So last week's homework was having a look at how many customers did your business lose last year? How many customers did you lose this year? Ideally with both the number and the percentage. And what are your targets for improvement next year? And do you know what impact this one business growth driver could have on your profits and the potential equity value of your business? If anyone wants to run through any of that at any point, please do give me a shout afterwards. If you couldn't work that out, I can help you. Now, if you've been following us each week, you should be getting used to reviewing Alex and KPI Software's key numbers. So just to be clear, let's flip those going in the wrong direction red and those going in the right direction green. We can see a lot of red, and just in case you have not guessed it already, today we're going to focus on this one key driver, which is retention. And as we can see here, this is reduced by 4.1% from the prior year. Putting all that information into a table, we've already looked at cash flow, stock, creditors, debtors. We've also looked at overheads and gross margin. So let's look at customer retention. We can see that Alex retained 4% less clients than he had from the previous year. With that trend, and if nothing changed, where do you believe that would end up next year? We know the retention would reduce by another 4% on that basis. So what can Alex do? At this stage, I'd like to hand over to Daniel Plowright from Enquir3. So Daniel and his team specialise in identifying opportunities within your existing customer base, making sure they stay with you long term and spend more time and money and generate quality referrals. So Daniel, really looking forward to hearing a bit more from yourself. I think Cliff's just let you take over the slides.
Oh yes, we're on it. It was seamless. It was
perfect.
Seamless. Morning, everybody.
Morning.
Good morning. Good morning. So yeah, what I'd like to do is spend the next half an hour or so just running through kind of this particular area of interest in terms of the KPIs, and then we'll leave some time at the end for Q&A. I'll just pick up any questions. With a relatively small group, we can allow some time for that. So that's great. We'll just make sure this is all working. So I think the first point that Gavin mentioned is ultimately you've got to know your numbers, and the issue here is that businesses often spend, if they're interested in the figure, if they're interested in the homework that has been set through these various sessions, then there can be an awful lot of time spent trying to establish what those figures are, and that's the bit that should be easy. That should be automated, and that's what Gavin's kind of alluded to. There are ways of extracting that information from your accounts, as it were, if you're using Xero, QuickBooks, or whatever it might be. There's a way of getting that information out that means that you can spend that time analysing and reviewing that rather than spending time doing the actual analysis. So the first thing we've got to do is we have got to know our numbers. And from the example business that we're looking at, this Alex's business, you can see that the figures are, they're just going in the wrong direction. And the issue here is, what impact is that ultimately causing? Because it's very easy when you look at these kind of reports to say that looks disastrous, which it possibly is in this particular case. But there may be an underlying reason as to why those are going in that direction. It could be that the business has changed focus in some way. It could be that they've identified certain customers that they didn't want to work with anymore for whatever reason. Maybe they were high overhead customers, or there were customers that they took on early in their life cycle and are now relatively low margin. Or it could be some other reason. But again, we've got to be careful when we do the first analysis of these figures. But if we take it as read that this wasn't a plan or wasn't intended, we can see that the actual revenue impact of what's gone on in this particular example is quite significant. And obviously, depending on the size of your own businesses, that will kind of have some relevance. The key issue here is that if this business is running on a gross margin of, say, 30-35%, then there's a significant impact in terms of what comes back, which is, I think you calculate about £16,000 worth of profit has gone somewhere, which is not going into the business owner's bank account or not being reinvested in the organisation. So you've got to have a handle on that figure. And I say the scale, if it's a big business with lots of customers, then that'll be a really big number, but it's all relative at the end of the day. It's still going to be important. And I think you then start to look at what causes this loss of customers, what causes the breakdown between the supplier, if you like, and the client, or the supplier and the customer. And Gavin alluded to the fact that the quoted average is this 19.8% or 20% if we round it up. And if we were having a debate about that, there would be a debate around the room as well. I don't recognise that number in my business. That seems really high, or it seems really low. I think the issue here is that businesses are often a little bit blinkered in terms of what we're actually meaning by losing a customer. Because if a customer ceases trading, or they retire, or the business, you have lost them. You haven't done anything wrong, but you've still lost them. Or if that customer has been bought out by some other competitor, and that competitor is choosing to use another supplier, you have lost them. So there's often this kind of mindset that says, to have lost a customer, I must have done something wrong. It's just a question of, well, how many are paying you this year or this month versus how many are paying you last year or last month. And one of the biggest causes of loss, a breakdown of that relationship, comes back down to this breakdown in conversation and this perceived lack of engagement. So that what we're saying here is that the customer feels that the supplier just has fallen out of love with them, doesn't care anymore. And that's something that the supplier particularly can do something about. The other big issue that comes in here is often the breakdown is due to perceived lack of service. So you've got perceived indifference on behalf of the supplier. And then I flagged an issue and you haven't resolved it to my satisfaction. So adding those two together, you've kind of got around 80% of the issues or reasons why the relationships break down is something the supplier potentially could have foreseen and potentially could do something about. Because often you get the excuse, if you've got an organization that's got a sales team, the excuse or reason that's often given is, well, we didn't pick up that new client, or an existing client didn't take this extra piece of business because it was an issue with price. And that often is an excuse, because that's probably a poor sales pitch around the value perception, because price, whilst it's the third biggest chunk, is only kind of 10% of the reason. So I would have an honest look at that area to say, we need to know these figures, which, as I say, Gavin mentioned, was kind of the suggested homework from last time. And if you can't get hold of that number, there's ways of working it out. And then it's being honest with yourself as to, well, there might be some surprises in there in terms of what you might want to do with business going forward. So if you look at customer engagement, retention, cross sales, and then ultimately referrals, what you're effectively going into is starting to understand if we make an assumption that business will lose some customers at some point for some reason, do we have any understanding of kind of whether they are satisfied or dissatisfied with the service that we deliver at the moment? And a lot of the work that we do, kind of what gives us the credibility to talk about this, is that we deal with a lot of client satisfaction interviews, which is where we will, as an independent third party, we will be having a dialogue with a customer on behalf of their supplier, and just trying to find out, doing a bit of a litmus test as to how they feel the relationship goes. And if you start to look at this again, you'll have some feedback that you probably are generating in some way. It might be that you're having a conversation, which is fantastic. I would certainly advocate that as probably one of the best ways of doing it. Or it might be that you're sending out an annual survey, or you might be sending out an email survey. However you're doing that, you're probably gathering some feedback. Obviously, depending on the type of product or service you have, you might be using other things like FIFO or Trustpilot or whatever it might be. Obviously, if you're in hospitality, you might be looking at things like TripAdvisor. But ultimately, you should have some assessment of scale. And again, the issue here is that whether you're using a 5-point scale or a 10-point scale, there's a bit of perception that if I'm sat in the middle of that scale, then that's kind of okay, because that's kind of average. And what I'm going to go through is some kind of background research that's been undertaken, which kind of suggests that that's not really going to be okay going forward. And it kind of comes back to this scenario that we've I guess most of us have found ourselves in at one point or another, where here we have got the supplier asking his customer a question, which is everything okay? And the natural reaction from the customer is, yeah, it's great, thank you, or yes, thank you. Because typically when this interaction is going on, no one wants to fall out with each other. We tend not to be aggressive in the UK and issues on service, and we'll just kind of take the path of least resistance. Mm-hmm. But key issue here is, what is that customer really thinking? So what's happened here in this exchange is that the supplier's asked something, the supplier's walking away from this discussion or this piece of feedback, let's call it, and thinking that's great, they're going to be back, where the reality is that they won't be back. And it's a question of, when you're having that dialogue, again, depending on the size and nature of your business, who's having this dialogue with your customers, and are they really being honest, let's say, in terms of how they're responding? And that's why we would suggest you've got to try and find a way, potentially, of, if you can find a way of a third party asking that question on your behalf, you'll tend to find that the customers or clients, however they're turning your business, will tend to be a lot more open in their responses. And what you're trying to establish is ultimately, where do they sit on some sort of spectrum? Are they advocates of your business, that they love what you do, and therefore they're going to tell other people about it? Do they kind of sit in the middle somewhere, ambivalent? Or do they, at the other end of the scale, right down to a scale of 1 out of 5 or 1 out of 10, they are upset about something, or they're annoyed about something, or they're passionately disliking something that you're doing? And then it's just a question of, well, what's the barrier here for them moving and doing something else? Now, if they're entwined in your business in some way, either that they're under contract, or that you offer them something relatively unique, or there's kind of high barriers to switching, then that disgruntlement would just build, because there's actually nothing they can do. They're annoyed that they made a bad decision in the first place. And that's the one thing they will do, is they'll make sure nobody else that they know, or that they have a relationship with, makes the perceived same mistake that they made. So they will go out of their way to tell other people. And the easiest place for them to tell other people is going to be on their, whatever their social network is. And that might mean it's Facebook or LinkedIn or wherever, or it might be, a networking environment where someone puts their hand up and says, I'm looking for a new supplier of whatever it might be. And these guys will pipe up and go, okay, that's great, but I can't recommend anybody. But one thing I would say is don't deal with this company because of the experience that I had. And it could have been a one-off bad experience, but again, you've got that scenario there with that word's being spread. And just because of the scale of this, what you tend to find is that those that are not happy, if we can badge them as that, on average tell 15 other people. Those that are happy on average tell 5. So whether those are very specific numbers, but the point is there's a lot more people that will be spreading bad news than people who are spreading good news. Clearly at the other end, the 5 out of 5 scale, they're going to go out of their way and say, I overheard a conversation, I hear you and you've got a problem with whatever it might be. These guys can really help you out. And I think you've got to also bear in mind that can come from people that haven't actually taken your service. If someone's inquired into your business about potentially you delivering some particular service to them and you've done a good job in terms of how you've proposed it, even if the timing wasn't right for them and they haven't moved forward, they're still potentially an advocate for your business. So again, it's starting to think about where these relationships sit. And the other key thing is understanding that once you've got this information, that you do something with it. And what this graph is representing is the fact that whilst a lot of businesses ask for feedback, commentary, whatever it might be, they tend not to do anything with it at all. So only half of them will actually go back and inform their internal team, and only 1 in 20 will actually kind of complete the feedback loop and go back to the client that gave the feedback and say, well, thank you for what you said. We understand we've got a challenge in this particular area and this is what we're going to do about it. Or we understand there's an opportunity here for us to have a discussion about another service. They just don't, they feel they should be doing it. They are doing it, but they're doing it badly. And my example of that is things like utilities companies, etc., who will, they will be asking you for feedback, often with, dear no name or dear surname, whatever it might be. I had one yesterday with, hey Plowright. I think that's supposed to be my first name in there, but anyway, whatever. Asking for feedback. I don't know about yourself, I don't respond to that stuff, but typically who's responding at either end of the spectrum, which we'll talk about in a second. So it comes back to this whole concept, going back to the reason the relationships break down is cited as saying that there's a perception of indifference. Well, you've asked me for feedback, you've not closed the loop. Now I'm feeling even more wound up about the fact that I gave you an opportunity to do something and you haven't chosen to do it. I think if you then dive into some numbers and we look at this example business again, there's all sorts of reports that can be relatively easily generated. As I say, the time needs to be spent understanding what this is actually really saying. So this, for example, this particular one here is, here's Alex's top 10 customers in the last 12 months. But there's a number of red flags on there, which suggesting that the turnover in those businesses is going backwards. Now, there could be a very valid reason for that, and that could have been an active decision. But the point is, unless you're looking at this type of data, you're going to really struggle to understand where the issues are. And quite often when we sit down with a business and say, look, just have a go. Just can you list out the top 5 or the top 10 customers that you've got by turnover? And they'll diligently scribble those down. And then you can compare it to a list that's actually on the accounts. And there'll often be some marked differences. They've often missed out somebody that's actually in their top 5. And it just starts to give you a kind of handle that often, we're all very busy and we're all doing other stuff, but these guys are clearly important. And often businesses don't have a real handle on who is the most important customers to them. So again, there's something that can be looked at there. And I think on the other end of the spectrum, you've got a report, for example, here, which is showing these are the customers that have got the biggest risk issue. And for a business that in this example is turning over around about £1 million, that's a fair chunk of revenue that's there. Now, again, there's potentially 2 sides to this story in terms of, are these less profitable clients? Was this a deliberate initiative? Was there a change somewhere? This example is a software business. You can start to understand that maybe there's some project type work involved in this. But again, until you've got sight of these types of figures, there's little you can do. You're kind of guessing, really. And I think the other thing here is businesses, deluded is quite a strong word, but I think it's getting a handle on this, and we talk about this in other sessions as well, which is, have I really got a handle on how active my customer base is? Because for every business, there should be a natural purchase cycle. And this is a genuine example of a stationery company that we were working with, where from their perspective, we offer great customer care. All the customers are really happy. That's fantastic. I've got, this is the MD saying this, I've got around about 850, 900 active customers. Okay. And so the conversation which then follows, which is, I think you could do something relatively straightforward and similar for your own businesses, which is what would be the natural purchase cycle on this type of product? Okay, you'd hope that businesses might buy monthly. Okay, would it be fair to assume that if quarterly, at least quarterly, we will mark them, if they bought quarterly, they're an active customer? Yeah, that's a fair assumption. So is it also a fair assumption if they haven't bought in the last quarter, they've either closed down, gone somewhere else, or something else has happened? All the scenarios we were talking about at the beginning. Yeah, that would be a fair assumption. And on that simple analysis, this business went from having 850 active customers to 250 active customers. And that is a massively different scenario for that business owner to get their head around. They genuinely believed, heart on heart, that they were in the situation on the left, and they're actually in the situation on the right. And when you come to one of the latest, let's say this was a long-standing business and they were looking to exit, and you come to one of Cliff's sessions later on, you'll understand that this chap has got a very big problem if that's where he's sat. So again, it's having that handle on your particular business, and understanding really why these guys left. Why did they leave? And I think it's having that honest discussion with yourself. And again, depending on the scale of your business will depend on how easy this is to do, because if you're doesn't matter really about the size of your business, it's about the size of your client base is how deep into some of this detail you can get. But you kind of follow the 80-20 principle really, and focus on those which are going to give you the greatest return. And I think ultimately you can start to look at the data set and say, okay, I would have expected this purchase frequency, I would have expected this average level of sale, and this particular client is a real outlier for some reason. And you can find some real huge opportunities within, as Gavin said at the beginning, within your existing client base. I think in terms of identifying areas for improvement, it then comes back to, again, some of the reporting that can now be automatically produced will give you a steer very, very quickly in terms of, again, this is an example screenshot from a report, which is showing kind of what's working well within this business and what's not working quite so well, putting it positively. And this business, as I say, the bit that's highlighted in green there is talking around how many clients they've lost in effect, or how many clients they've actually managed to keep hold of. And it could be that, as I say in this example, it could be that there is a subscription model underlying this or something that's going on that we really need to dig into some of that detail and find out. And I think ultimately is this type of analysis that's quite important, is understanding kind of direction of travel. And again, there is a tendency, and I know I'm laboring this, but it's about everyone's got the same amount of time in the day, and it's a question of how they choose to use it. And what I wouldn't want businesses to be doing, or suggest they shouldn't be doing, is having to spend ages analyzing stuff. You've got the data's available, it gets extracted into a spreadsheet, and then they spend way too much time creating this type of informational output. This informational output is available, and therefore you're now in a position where you can do something about it. So this is the importance about the tracking and monitoring, which I know has been a kind of consistent theme throughout these presentations. I think it then comes back to, do you understand really what the desires and demands of the customer base are? Because they formed a relationship with you off the back of some offer that you made. You solved the problem for them at a point in time, which meant they're a customer and they're giving you some money for something. Over time, your proposition may have changed. You may have added things to that proposition. And there's often an assumption by the business that the customers completely understand that. They have read every single email that you send them. They've digested it. They've filed it appropriately. They're on top of your website all the time. And they know exactly what you do. Of course, that's not the scenario. Some of the advocates might be, which would be a bit scary. But the reality is most customers are not on a day-to-day basis in tune with what your offer is. So this is all around the whole concept of, have we run a gap analysis, or whatever you choose to call that, which is understanding where the revenue opportunities are. If you've got, half a dozen different services or products that you offer, and I as a customer am only taking one of those, are you absolutely sure that none of the other 4 or 5 are absolutely relevant to me? And often what we get when we get feedback coming in is the client will say, oh, I think this supplier is fantastic. They've done a great job for me. And we ask the question, is there anything else you feel that this supplier could help you with? And they turn around and say, no, I think they're fantastic, but no, there's nothing else. And I can give you numerous examples where we've gone back to the business and said, the reason they're saying, you're sitting there very happy because you've got this really great piece of feedback. The key issue here is that customer doesn't really fully understand what you do, because if they think you're that great, are you seriously telling me there's not something within your portfolio of what you could offer them, or one that a referral partner can offer them? You're just closing off that opportunity kind of psychologically, because you're going, right, they're happy, we did a good job, we move on, which is fantastic. You sort of obviously celebrate that success, but don't lose out on the opportunity. And it's a question of how you kind of conduct this type of analysis, which is really important in terms of the gap analysis around what else you can sell them, which is kind of, I would typically say there's a 20-30% sales opportunity often within that mix. Whether they're a referral potential, and there's a whole conversation around referrals, and whether they're a case study target. And the reason we're flagging these particularly on here is that referral opportunities are huge, which we'll talk about in a sec. And then from a case study point of view, you're looking for that. The reason we're flagging that is because you're looking for that evidence. If you're going to target a particular market with your service, you want your marketing sales material to be as focused as possible to a particular market. And therefore you want a case study or multiple case studies from people in that market who say, if you're looking for this solution for this problem in this industry or this sector or whatever it might be, and there's nowhere else you should go other than speak to these guys, because look, they've done a fantastic job for me. And if I'm reading that as somebody with a similar problem in a similar industry, I'm more likely to engage rather than just looking at something that's very generic. So it's then again about being targeted. I think the other issue here, which we've touched on, is being careful when you're kind of reviewing, if you are capturing feedback or you choose to start capturing feedback, is how you analyze or review that data. And we talk about customer complaints, and this is off a fairly big piece of research that was done a couple of years ago. And obviously all these numbers have kind of changed around a bit in the last 2 years or so, but the kind of underlying principle is still the same, which is for every complaint, and that complaint might be a ticket or a mild irritation, complaint's quite a strong word, for every complaint that comes through, the view was that there are a lot of complaints that don't get mentioned. And the ratio they came up with in large organizations was 1 to 26. So for every complaint that comes through, there were 25, 26 that didn't get voiced. Whether we agree with that number or not is kind of not the point. The point here is that if people are got a mild irritation that you're aware of, then there are probably some customers out there with the same irritation that you're not aware of, because they're just choosing not to engage with your process. And it's, I guess we've all been in this situation. I'm mildly irritated to very irritated about something. How much effort am I going to put in to try and resolve this with the if you're tracking this as a KPI, try and find some way of just having an assessment of whether what you're looking at are actually the real figures. If you're running a business where clients raise tickets, for example, if you were an IT related business, then you're more likely to have a better handle on this, because it's easy. There's a fairly easy process for them to engage with you. The other part of this is what they call the silent majority. So when businesses ask for feedback, let's use the example of business going out and asking for feedback using a email survey, which is kind of default for a lot of organizations. Typical response rates on that are around about 30% on average. And if you get better than that, that's great, but on average. The question here is who's actually responding? And so if you've got this spectrum of customers from not very happy at all to ecstatic on the other end, typically the people that respond are either ends of this bell curve. So what you get to see on your iceberg, go back to that, is 2 ends of the spectrum. So then you look at your data and you average it all out, and then you've got this kind of average position that you're taking a management decision on, where you've got this huge group of people in the middle, which they call the silent majority, and you haven't got a clue what they think. So it's a question of how you engage with them, because often, I mean, again, you'll start to see this as you kind of engage in retail environments, or whether you're getting feedback surveys from businesses that you've done work with or that have supplied you. You start to understand what is motivating me to respond to this survey request or this feedback request. So you just got to try and find a way of engaging with that. And I think it comes back to, right back to the beginning, which is proving that you understand the issue and that you care, which goes back to this chart. It's about this kind of lack of engagement, or just the feeling, the perception that there's a level of indifference. You took my money. I'm not saying it's as bad as this all the time, but you took my money and I've kind of slightly fallen out of love with you. And it's this whole concept of, why is it the new customers that get the best deal? And I think I see this now, that a lot of the larger companies are kind of realizing that they've upset, annoyed, whatever, a lot of existing customers, but offering these really keen deals to attract new people without rewarding them for their loyalty, as it were. Then the other thing to consider here is that these charts show that this piece of analysis was that if I score a 5 out of 5 or 9 or 10 out of 10, then I have got a very high propensity to remain as a customer and unlikely to recommend, which is fairly obvious. And that's the kind of 96, 92% on here. So if I score 5 out of 5, I'm 96% likely to remain. If it drops down to a 4, that scale drops right back to 66%. So again, when you're looking at your data, if you are looking at your data and you're thinking, oh yeah, my feedback scores on average, I'm a kind of a 3.5, 4 out of 5, that feels okay. And then you look at this, you go, actually, we need to be aspiring to, and we won't get everybody there, but we need to be aspiring to a higher number, which is what this is talking about. And then just kind of touching, the last bit is just touching on kind of forecasting and how important this bit can be in terms of your overall marketing mix. And I think this again was mentioned by Gavin at the beginning, which was, there is a tendency for businesses to say, right, okay, I've got to go and do some marketing because I need to bring some revenue in. And there's a whole conversation that we'll have in a session in 2 or 3 weeks' time about how that potentially can work and also how it can potentially go wrong. If I just walk you through this kind of relatively simple example, as a business, you may well or you may not have you've got a sales forecast. You've got an expectation of what you would want to achieve each month over the next 12 months. There's some numbers. So here's an example of a business, got nothing to do with Alex. This is a different business I've just made up. And there's a bit of seasonal variation in there. Okay, fine. So it's not a flat line throughout the year. As a business, based on all your experience, there's probably a baseline that you would expect that you'll say, look, with a limited amount of effort or just our day-to-day running, there's a level of sales that we would expect to achieve. And therefore, all of our kind of marketing business development activity has got to fill that gap. And if we aggregate it up for this business, just to make the numbers up, let's assume that of the 100 we want to achieve in the year, we're fairly confident we're going to get 70 without too much extra business development activity. And this is how this can build up. So you're saying that 30 gap, that's what my marketing's got to sort out. I think you can break that down a little bit further than that. So if we start off with our 70, what businesses tend to forget is they tend to forget about the fact that they're going to potentially lose some customers. So in this example, we've lost some customers just because we have, for some reason, and also we've got an impact of COVID, which might have taken it a little bit further than we'd anticipated. So blimey, our gap is now not 30, it's more like 45, 50. And that means all my marketing activity has got an awful lot to do. But I think before you even get to your marketing activity, the key issue for me is there's a whole bunch of stuff that can be done around retention, upsell and cross-sell, increasing frequency and transaction. Referrals is a massive opportunity. So all of a sudden you're building this back up and then saying, oh, actually, my pure marketing to people that I have no relationship with yet, is actually not having to do such a big job, and it's just a question of balance. So if you look at it this way, in terms of the relationships that you've got, we've got some past or soon to be past relationships. Can we do anything to reignite some of that stuff? Because some of that is in our control. And even if a customer is gone, obviously depending on the nature of what you do, is there a way of bringing them back on? Yeah, they might have shifted for the wrong reason. They might have shifted because of price. They might now be realizing 3 months later that all is not as good as they thought it would be. Is there a chance of enticing them back? We've got the current customers with a whole bunch of stuff we can do, which we've been talking about. We've got businesses don't ask for them, and we'll talk about that in a different session. And then we've got people we don't know yet. And what this is representing here is, again, was mentioned at the beginning, is it's just a lot more expensive to attract a new customer than it is to keep hold of a current one. And I could quote figures of it's 8 times or it's 7 times, but there'll be a figure that is relevant to your sector. It might be just twice as expensive, or it might be 10 times as expensive, but it's this balance. And the issue for me is just, where should you spend your time and effort and energy within this spectrum? Because businesses tend to dive to the right and go, right, I'm just going to do all this stuff, and a lot of it's not very well thought through in terms of its targeting. The messaging's not right. Businesses get upset they're not getting the return on the effort they're putting in, and it's a bit depressing. Whereas if you spend some time in the middle of this, or to the left hand side of this, you can actually get some rewards fairly quickly. So again, I think it comes back down to understanding this kind of transaction value analysis as well, in terms of understanding that, as this said, not all customers are equal, and you just got to follow the 80/20, chunking it down on the 80/20 principle to understand where you should be focusing your time and effort. And again, I appreciate all businesses are different. If you've got a lot of customers, then you've got to try and find a way of identifying those that are going to give you the greatest return on effort. And it also is going to depend on what resources you've got as well. And just to kind of close this off in terms of a couple of examples, is that if we go back to Alex's business and look at this, we can see that, yeah, on the current trend that the trajectory that they were on in terms of this client attrition figure, yeah, you can see them dropping from the kind of 80K figure that they're at the moment, and that's going in a negative direction. Even if they stabilize that, it's still starting to drop off. But just a reverse on that one, just in terms of flipping it, all of a sudden you've gone from an 80K net profit to near on 200K net profit. Now it might be, and as Gavin has said throughout these various presentations, these KPIs and this marginal gains concept, which is, we might not be able to flip that completely in the opposite direction, but even if we did half of it, then that is quite a significant impact. Now, if we add that to the little nudge that we've given on gross margin, or the nudge that we've given on transaction value, then all of a sudden these things aggregate and have a massive impact. So I think that's why specifically we've been talking about client attrition and client engagement today. So I'm going to hand back over to Gavin, I think, on that one.
Thanks, Daniel.
No problem.
So, yeah, thanks for resharing that. So yeah, I really appreciate you running through that. It's very interesting to see how easy it is to lose those undervalued customers, but also how easy it is to rectify with the right questions and getting the right information in. Just quickly, before we go to questions, we've now covered 4 out of the 5 KPIs. So we've covered overhead and quick win cash, cash flow, debtors, creditors, stock work in progress, margins, and today's session was about customer retention. So I just wondered if there are any questions or any key points anyone would like to highlight or discuss or ask Daniel.
Hi. Yes, it's
Carry on, Raquel.
possible to. Sorry, I'm driving, so it's impossible for me to have my camera on. But could I just ask you something, Daniel? I mean, your customers, when you're talking about your customers, I have a property investment, what is that business? And when I see I have 2 different types of customers. Yeah, I have my tenants, which obviously I try to keep as long as you want, but I also have my investors, which is the people that invest in the company or do private loans to the company. Now, when I'm looking at this profile of yours, obviously I don't work with huge amount of customers. I don't work with a lot of investors. I work with about an average of 5 to 10 a year, depending on what it is, depending on the year. and the projects that I have. But I mean, how do you suggest that I look at this? Because obviously it's not the same when you're looking at 10 customers than when you are looking at 100.
No, I suppose the question there is that's a fairly unique business model, which I'm kind of familiar with. I know somebody that runs something similar, and I guess the question there is that, as you say, the tenants are not going to move around that quickly. But the question, I suppose, is there a challenge there in terms of, if you're finding it relatively easy to bring on investors, then great. Maybe there isn't a burning issue there. But yeah, if you had double the number of investors, is that something that you could accommodate in terms of doubling the number of investors would then bring on double the number of properties and double the number of tenants? And therefore you might, I don't know if there's an angle there at all in terms of that client base of investors, expanding that, and whether there's the connections and referrals that they make. But I would sense that you're probably on top of that already. It's a question of what problem we're trying to solve. Is there a burning problem in relation to this particular area in that business?
Yes, there is, because obviously for me, it would be a humongous amount of easier if my investors just kept on investing with me. But obviously that's something my average, when it comes to my tenants, they tend to stay longer periods of time anyway. Yeah. So I'm quite happy with that. And then when they go, is because it's part of time. It's a lifespan, if that makes sense. They normally stay 2 to 4 years and then they go. So that's great. But when it comes to the investors, I would then rather be for longer periods. Although again, this is a lifetime. It's not a lifetime investment that they do. It's for a certain amount of periods until they reach their goal, their financial goal, and that's it. And then they done and dusted. So how can I apply that to actually keep these investors? Because that's where the massive issue for me is.
Well, I wonder whether there's again, I don't know the market that well, but whether there's something got them excited to bring them on board in the first place. Mm-hmm. They perceive there's a kind of fixed window of return, let's say, on whatever they're doing, or there's a fixed time frame for that relationship. And I guess it's a question. And okay, if I've signed up and I expect it's either whatever it is, a 4-year time frame, then that is I've set an expectation that is the length of my relationship with you. So maybe there's something there about how this is positioned in the first place, or in terms of them reinvesting. Certainly, given that you can't get any interest in any bank account at the moment. So if they're high net worth individuals, I would have thought that they'd be interested in kind of spreading that even further.
I think. Yeah, I guess you are right. I guess it must be on the wording at the very, very beginning, because it's the high interest rates that brings people to me. No questions asked. So there's nothing else about it. It's just great business rates.
Yeah, and I think it's that question of, if you go back, you've onboarded them, and I'm not saying you've forgotten about them at all, because there's a relatively small number there, and they're relatively easy to deal with. But I suppose it's just a question of how you're managing their expectations through that period. Or I've invested, okay, well, that investment's a 4-year time frame. Okay, I've now got another investment opportunity which starts 2 years into that one. So you've got them overlapping, going through, and maybe there's a communication or a reporting mechanism that could be put in place that would keep me in tune to say, look, I made the right decision the first time I invested with you. 2 years later, is there another opportunity? Something like that.
Okay, so just keep on presenting them more options. Yeah. That's what we're talking about, isn't it?
Also, Raquel, how often do you speak to those customers, those investors?
She's gone.
She's there.
Sorry, my muting just got automatic. I speak to them once a quarter. I'm wondering whether I should speak more often to them, and then just or send them, because I don't give them, obviously, because everything is on a direct standing order. They get used to the money very quickly. So other than that, I don't tend to talk to them other than saying, is everything okay? Is anything changed? But I don't really ask for more money, because obviously that's the money that I know that they want to invest. So
I suppose that sorry to cut across you. I think that comes back to the Cliff was alluding to as well. You're assuming that the circumstances, that didn't mean it sound like, but you're assuming the circumstances that I came to you with when I first invested are still the same. And my circumstances might have changed dramatically to the positive. and therefore I might have more money that I wish to invest, but because I haven't had that dialogue with you, I might be looking for another home for it. I might not. It goes back to what I was saying at the beginning. I might not naturally think you have other opportunities for me, so I'm going to go and find somewhere else to put that money.
Okay.
So I think touch base with these people every month. Yeah, I'm not saying the monthly, but and I think that would be a conversation with them. Is that you would be saying to them, other opportunities potentially come up. With your permission, I will touch base with you every 2 months or so. And over a period of time, you'll be able to establish whether that is the right frequency of contact for that particular person. And it might be that I'm not interested and I just want to hear from you once a year. Or Cliff might want to hear from you every month.
So it's just asking them, how often do you want me to contact you to talk to you about future opportunities then?
Yeah.
Yeah, every customer is different and they have their own different needs. So you can tailor your entire offering to each customer. And because you don't have hundreds, you can actually have a more of a bespoke sort of review system or questionnaire that you can speak to customers on a monthly, quarterly, half yearly, yearly basis, depending on their needs. But again, it's just really touching base with them, seeing where they are, explaining your new offerings, new opportunities. And if they're then obviously free to take those opportunities up or to ignore them. But at least you've voiced it and you've touched base with them so they understand where you are.
Excellent. Thank you.
Yeah, I really appreciate that, Daniel, Cliff, because that was something Raquel, when she started on these on the workshop, she was really interested to find how it would work for her, because it seems so different in weeks sort of 1 to 5. But obviously this is now kind of her area of like how to grow it. So appreciate the response on that one.
That's perfect, David. Thank you.
It's all right. No. Were there any other queries, questions?
No, I think not.
Some good things to look at for us as well, Linda.
Yeah, absolutely. I mean, this is funny enough, just exactly what I've been working on this week. I quite like the idea of having some sort of program, especially with new incoming staff. Because the point you've made about when was that client last spoken to, if you've got 3 or 4 people in the room, one person may have done it, but the other clients aren't aware. We've got a database, but it's a really clunky thing when you're in the middle of flowing and doing the work to kind of record, we spoke to that person. So that's something that I think I need to know, especially as I'm planning, as time goes by, on not being there 5-6 days a week. So I'm going to need to know what those guys are doing. I liked your little graph things, but in many ways, as theatrical agents, we haven't got time to sit there playing with percentages. But as the owner of the business, I need to know what those percentages are. We've had a lot of client loss, weirdly, in the last 3 months since the clients have started going back to work. We had a minimum client loss during the pandemic because we were doing lots of TLC for the clients, new website, everything we could think of, international promos. I personally was very proud of our client retention and what we were doing for them. As soon as the actors start going back to work, and weirdly, back in June, I said, they're all happy now, just wait till the contracts start flowing in again. They'll find something to moan about. So it's a weirdness, but obviously what we've got here is not just acquisition, retention, loss, we also have active poaching. So whilst we're doing this, there's somebody out there, agents with more staff than I've got at the moment, actively chasing those actors. And, we've done it before now, keeping an eye on certain agents' websites, looking at activity, then targeting people on social media, following them, getting them to follow us. So it's a potential minefield. And I want to get this right this time because I've got new staff coming in. I'm planning on a day of interviews next week if one of the staff who's actually in the process of leaving has actually booked them in for me. So it's a turnaround, but I'm actually now starting to look at it instead of the huge, great big threat, the nervous breakdown. I'm looking at it as a great opportunity to go ground zero. What do we need to bring in to move this forward? So I kind of foresaw this client loss. I mean, it's for all sorts of reasons. One girl I spoke to yesterday who was an actor, musician, really sweet, she's been offered a job in a museum where there's lots of customer interaction. Now, for that museum to get hold of that member of staff is amazing. An actor who can do all those wonderful things and did the community degree at East 15. So she knows her onions. So she's going to talk to me in the beginning of January, but I don't think she'll come back. Because
let's see, Linda, let's see. But
yeah, well, they're offering her a salary that's more. So these are the things that is quite interesting to look at. How do we analyse it? Because it would be good to have some sort of software, is what I'm getting at, where we can see what happened to January, loss, attention, acquisition, etc., etc. So maybe that's something you could advise me on.
Yeah, well, the other thing on that, Linda, without knowing your business, is that you just flagged at the beginning of that was it would be different terminology, but I talk to businesses where they say, well, we draw a line in the sand with our clients every quarter. We do a QBR, we do a quarterly business review. And then as the MD of that company, you sit there and you say, there's a box on here that's ticked that says that quarterly business review happened. But are we actually convinced they had the conversation that we wanted? Because this is some challenge you could put back to these new members of staff, which is, when you were having that discussion with that client, did you actually ask all of these questions, or did you just ask the first one, which is everything okay? Yes, everything's okay. That's fine. What businesses tend not to do is they tend not to dig for they're not looking for a problem. So they tend not to ask, is there anything, along the lines of, is there anything else that you feel that we could do to support you better? Because they sometimes don't want to hear the answer. And it's kind of that, are you absolutely sure there's nothing, Well, actually, now you mention it, I think that your billing's a bit rubbish or whatever it might be. Okay. And then it goes back through that whole presentation, which is now let's close the loop. The client has said something that we might disagree with them, and that's absolutely fine, but let's explain to them why we're disagreeing with them. And it's just making sure that it's not becoming a tick box exercise internally.
Yes, yeah, but I think my business is very far from tick box, but I guess there is the danger. I've told that member of staff to speak to XYZ between Monday and Thursday. So they might think, oh God, it's 5:30 and I haven't spoken to X. Quick, make the call. Oh my God, it's nearly 6 o'clock. I want to get out because I'm going to see the show. Done. But I can tick the box and tell Linda I've done it. So yes, that's that. But you just crossed my mind thinking in terms of, should I create a template of questions that they need to discuss? So that's something. Each one of my actors is obviously very different, but a question, the are you okay? And the flower.
It's a customer care question.
Yeah.
Client care questionnaire. It doesn't need to be onerous. It just needs to make sure that we've teased out whichever the key issues are for your business, really.
Absolutely. So is there something that you have that is a sort of client care questionnaire that's standard for other businesses that I could have a look at just to see?
Yeah, I mean, I can send you something over and you can, it's really straightforward, but you could easily tailor it so what I'll do, Gavin, is I'll forward it over to you, Gavin, and then you can forward it on. If that might be the easiest way of doing it.
That sounds like a plan. Thank you very much. Because then I can think through that, because there's always something you don't know and maybe something I haven't thought of, but I've got to stop the poaching if I'm going to make up for staff loss and the pandemic.
I think it's a good idea for you to have a chat with Daniel, Linda.
Yeah, I think that's a brilliant
idea. I'll put you in touch. And if anyone else wants to, just let me know, but I'll send out some details after this with his contact details.
Right, that was perfect for me. Cheers.
Any other queries, anyone? Are we all good to finish? So, I think the one that just popped up before then, Daniel, sorry, was key takeaways. So, just really good idea to speak with the existing customers, to ask for feedback, use their responses to help grow your business, and not to only retain more customers, but to grow that client base. So, here's where we currently are. So, on week 6, we've now covered 6 out of the 12 sessions, and we've already found loads of ways to improve Alex's business. We'll have another 2 sessions to dig into before we move on to customer acquisition, which Daniel will be back for again to help us out. So to prepare for next week, how do you segment your customers? I'm just going to set you some more homework. So how do you categorize your customer? Because not all customers are the same. So can you try and segment your customers into groups that reflect similarity? Can you calculate the number of transactions for each customer or segment? And do you know the average transaction value for this year, last year, and for the next? Any questions on what those are, please do just contact me afterwards. And it's just thank you from us for attending this week, guys. And thanks for your queries. And thanks, Daniel, Cliff, for your input.
No worries.
Really appreciate it.